My name is Elizabeth Patterson from the Tax Institute, and I am here to introduce a great tax planning tool for appreciated property called the Like-Kind Exchange. Normally, when you sell your property at a price above what you paid for it, you will have a taxable gain on the sale. This gain will be reported on your federal income tax return and increase the amount of tax liability you owe. One way to defer this gain recognition and the resulting income tax liability on the sale of business or investment property is to exchange the property for similar property under the like-kind exchange. This is often used for exchange of a house you are renting or holding for investment. The gain that would be taxed if you sold the property can be deferred until you finally sell the property you have exchanged your property for. To qualify for like-kind exchange treatment, the following requirements must be met. First, the property must be qualified property. Some properties do not qualify for like-kind exchanges. Second, the property transferred and the property acquired must be primarily held for productive use in a trade or business or for investment. Third, the property must be like-kind property. And finally, the exchange must occur. Many taxpayers mistakenly believe that they can sell their property and use the cash to purchase like-kind property and still qualify for the deferral treatment. This transaction is a sale and purchase, not an exchange. Properties are like-kind if they are the same nature, character, or class. What does this mean? Well, most of all types of real property and land may be exchanged for any other type of real property and land. For example, a beach home in Miami you rent may be exchanged for land in Beverly Hills that you will hold for investment. Even if the exchange does not occur at one time, like you transfer your old property and then after the transfer receive the replacement property, you may still qualify for like-kind exchange treatment. However, there are certain time limits to such exchanges. Also, you can acquire the replacement property before transferring the old property. Again, there are certain time limits and rules in which the exchange must be complete. Although most of the gain can be deferred, if you receive cash with the like-kind exchange property, the cash received will result in a taxable gain. Likewise, if your mortgage is assumed in the exchange, it is treated as receiving cash and you will have to recognize the gain. The like-kind exchange must be reported on Form 8824. Sometimes a like-kind exchange is not the best option. If you have property that has lost its value and you would like to deduct the loss, you should sell the lost property and separately purchase the replacement property in order to deduct the loss on the disposed property. If you are considering disposing of one property and acquiring another property similar in nature, consideration should be given to structuring the transaction as a like-kind exchange in order to prevent you from recognizing a gain and income tax liability.